Hello, everyone. We will wait here a few more moments to make sure that everyone can join and can connect. So let's all just grab maybe something to drink. It's very warm outside, we know it. And let's just wait 2-3 more minutes to make sure that as many people as possible can join and don't miss anything. I can see that the room is filling up nicely. We're still expecting a few more. So as I said, get a coffee, get a water, maybe something sweet to eat, and then we will start shortly. One information that I'll also share later on, there will be a Q&A session at the end. So if there are any questions that you might be having that come up during the whole webinar, feel free to just drop in. Above there is written chat, and then depending on your language settings, Q&A, or if it's German, FNA, for instance, just drop in your question there, and we will get to it at the end. A few more people are dropping in. Nice. I'd say we'll wait another minute before we get started, just to make sure that everyone can join. Okay, I think I will just start. I'll just start with a simple introduction. My name is Verena Pichler, and I will be your moderator today. I'm very happy that you all joined us today. We have roughly 60 minutes together, including a dedicated Q&A session at the end. So as I said before, if you have any questions, just feel free to tap the F&A or Q&A button on the top, write down your question, and we'll make sure that at the end that there's time for them. For today's session, the topic is Beyond Stocks, how real estate and tangible assets strengthen diversification. And I think it's a topic that is not just relevant, but also really important for myself, because we need to start looking beyond the traditional mix of savings, stocks, and bonds. And I mean, especially in Switzerland, people are so careful with money. We save a lot and we think long term, but preservation often comes before chasing returns. And that approach is rather traditional, I would say. So this webinar is not like a simple two separated presentations webinar. No, it's like an active conversation with two market experts, and I will guide us through the different blocks that we're having today that you can now see on the screen. By the end, the goal is that everyone walks away with a clearer view of how to think about real estate and tangible assets can play a role in building a more resilient portfolio. The two speakers we have with us today are David and Aurelio. And Aurelio, if that's all right with you, I would like to ask you to introduce yourself quickly.
Sure. Thanks a lot, Verena, for the lovely introduction. My name is Aurelio Perucca. I'm one of the co-founders and CEO of Splint Invest. My background is in audit advisory, mainly in the financial industry. I have dealt with many regulators and have done a lot of regulatory work for banks in Switzerland, but also abroad. And 2021, together with my former colleague at PwC, Mario von Bergen, we have decided to start that very exciting journey of building our own company. And now, 5 years later, we are running Splint Invest, which is the biggest European platform to fractionally invest in alternative assets like art, cars, wine, whiskey, watches, Lego, basically everything with a tangible value, which can appreciate over time. Over the last couple of years, the variety has become very, very interesting and exciting. Recently, we also start with Pokemon cards, sport cards, coins. So as you can see, it's a large and broad offering, going fully into the topic of diversification, which is as well very relevant for our discussion today.
Thank you very much. What about you, David?
Thank you, Aurelio. Verena, Aurelio, I'm very happy to be here today. I'm David El-Eini. I'm a co-founder and chief operations officer here at Foxstone. Foxstone is a Swiss real estate investment platform that gives private investors the opportunity to invest in various real estate projects and opportunities across Switzerland through a digital platform where we enable investors to become co-owners of income-producing assets and to finance real estate projects. Investments typically start from 10,000 Swiss francs, and projected annual returns range from 5 to 7%. Since 2018, since inception, we have generated the volume of transaction of more than 400 million and distributed roughly 16 million revenues to our investors. We are today very proud to count on a large community of 31,000 investors in Switzerland.
I am very happy to have you both here, and I would say let's dive straight in. So Switzerland has one of the highest saving rates in the world, and yet a lot of money still sits in bank accounts. What is pushing more people to look beyond cash and traditional investments?
It's true that it's quite amazing that the percentage of saving that we have in Switzerland. It's roughly 18% of what people earn, so it's the highest percentage in Europe right now. It's true that cash feels safe. It's always a security, but the reality is that the nominal value of cash doesn't deteriorate. But in an environment of very low interest rates, not investing is also taking an investment decision. And what we are seeing right now is that many investors are asking themselves, should I keep a lot of cash because I need more security? Should I be taking more risk? Should I put my capital at work? And we really believe that there's a strong balance to be found out there, because in the end, cash is obviously a strong preservation of security, but in the end, it will not preserve purchasing power. So it's important to have a right balance between the right amount of cash and security and a diversified portfolio that enables you to put your capital at work.
That's I couldn't agree more. Swiss investors are often described as very conservative and long-term oriented. Are you seeing like a change of mindset, or are investors looking at new ways to stay conservative while still putting their money to work, as you just mentioned, David?
Well, I think that Swiss investors remain conservative. I just think that the mindset has changed. What people are looking into is to invest in more smarter solutions. They want transparency. They want to have a better understanding in order to take more informed decisions and to get a real understanding of where they're investing and why they're choosing a specific asset class. So I would say that for me, but I'd love to hear Aurelio on that. I mean, the mindset has not changed. It's just the approach that's evolving.
I fully agree, David. So what we can observe is as well that the Swiss mindset is still the same. But what has changed from my perspective is the level of education and the understanding of the underlying investment opportunities. So we still see that there is a lot of security buffer built in portfolios. There is still a lot of liquidity being put aside for emergencies. this idea of preserving money, even for the next generations, is still very dominant. We can confirm that. But what we can see, especially on our platform, is now that more and more people understand that different asset classes, they have a different purpose in a portfolio. And some asset classes, they are here to, either reduce the risk, delivering the same return, or keep the risk stable, but aim for a higher return. And on our asset classes, typically people search for higher returns, accepting a certain level of risk. But again, that's not a mindset topic. I think it's an education topic.
I couldn't agree more. Before we go deeper into real estate and tangible asset and asset classes, I think it's important that we also take a step back and talk about diversification itself. I mean, it's a word that we all use sometimes daily, but we all don't necessarily mean the same thing by it. So I would like to make sure that we are all on the same level here. Therefore, a lot of investors feel diversified because they have a pension fund or a pillar 3A, maybe some EFTs, some savings. But where can that impression be misleading?
That's a very good question, and I already started to tap into my a general definition of diversification, right? So from my perspective, it means that we are allocating our money into different investment opportunities with the goal to either keep the return stable and distribute the risk or lower the risk, or to keep the risk stable but increase the potential return on investment. And from my perspective, having our money invested through a pension fund, Pillar 3A products, and general market representative ETFs is not a bad thing. I would say that's a sufficiently diversified portfolio for a beginner audience. That's also basically what I would call the core of any portfolio. However, all those asset classes have underlyings which correlate with each other quite heavily. And that's the misleading part, right? Even if you invest in ETFs across different geographical regions, the underlying economy is still the same. And the impact of inflation or capacity issues, supply issues, they all have the same impact on all those economies. And therefore, the total markets are heavily correlated, and negative situations translate into very similar patterns when it comes to value development. So I think that's why I would call it following this rule, you are diversified within the system. Adding real estate, adding alternative assets like art gives you a diversification outside the system, which from my perspective is then the true diversification.
I agree, Aurelio, and I would even say that true diversification in the end is having a balanced portfolio that doesn't react in the same way to the same news. And in the end, what you're looking is different drivers of return. And that's true diversification, is assets that behave differently. And I'll speak more about that later, but in terms of crisis, because in good times, everything looks good, but it's in the bad times and in crisis that we see how assets really behave.
I would like to really join in with the next question here, because I think you already started to answer that one a little bit. Many people think that spreading money across different stocks, funds, and geographies is enough, but where does the logic break down?
Well, the logic breaks down when things don't happen the way we would have expected. So mostly during crisis, I mean, correlation, as Aurelio described, always rise during periods of stress. So assets look very differently in the way they behave when they're into stress, when they're into crisis, and they suddenly move together in a direction that one would not have expected. So in the end, it's about really diversifying and owning assets with different economic fundamentals. And speaking of a subject that I understand, I mean, the real estate angle is obviously, and the real estate fundamentals are linked to very different parameters than listed stocks or ETFs or bonds. I mean, they're listed to rents, to occupancy, to population growth, to supply constraints, to demand, to new housing, to many different parameters that are linked to real life usage. And I think this is very different. It's also very tangible, extremely comprehensible for investors as well. And I must say that, especially in Switzerland, these fundamentals remain extremely strong. We have a very healthy residential real estate market, which is heavily protected by different regulation. And in the end, I mean, these fundamentals remain strong, especially right now. So I would say that in terms of diversification, you always see what happens and the movement that assets are taking when you need the most diversification, but when crisis hit the most. So that's what I think.
I totally agree, David. And maybe just one comment to add here. I think the logic also started to break recently, because we have to understand that a lot of the theory developed around how to invest money is like 50, 60 years old, even 70 sometimes. And the world changed since then. Everything became more global and interconnected and depending on each other. And I think that changed, that also caused this change of correlation, right? Before, it was true that if you're diversified across different regions of the world, you're good, right? Because not everything was interconnected and not globalized. Today, that changed. So I think that's also what is causing this logic or let's say old mindset to break nowadays.
I agree. And access to information today is instant. So when there's the news, everybody knows about it, and then the market sentiment spreads and you have strong reactions and strong volatility in very little time.
Those are some very good points. And again, it started to answer a bit also the next question, which is about like the market stress. So I would like to know, like, can you give us an example of how your asset class behaved during like a period of market stress? And what does it tell us about its role in a diversified portfolio?
Well, I'll give you two examples. The first one is the 2008 financial crisis, and the second one is the sudden increase of interest rate that we've seen in 2022, 2023. What happened in the market was very clear. I mean, listed real estate funds corrected sharply and instantly. But what's interesting about this assumption is that the underlying assets, the buildings that were held by these funds, did not move much into valuation, especially in Switzerland. Why? Because again, I mean, the buildings themselves take a long time to change in valuation, whereas a listed fund moves with news, market sentiment, liquidity inflows, and that makes a big change. In the end, during that time, I mean, in Switzerland, I speak about a market that I know, not about other markets, but tenants did not disappear. Rents were still collected. Occupancy was still very high. I mean, people were not leaving their home. They still needed a place to live. So there's a very important distinction, is that obviously market prices can move quickly, but the underlying real estate takes time to evolve in terms of valuation. And why? For the reason I explained earlier. I mean, it's driven by rental demand, by vacancy rates, and by limited supply. We live in a country where there's a limited supply of real estate. I'll speak further about that later on during this talk. But I mean, we have 1% vacancy rate in Switzerland. It's not even enough to have a healthy market and to see, a market that's dynamic. There's a clear housing shortage. So all these parameters have a strong impact on the valuation of the underlying assets, which for now, I would say stays very steady in terms of valuation and has been growing for the past 30 years. So yes, the stock markets can move very quickly, but the underlying assets take a long time to evolve in terms of valuation. And that's what we've seen during financial crisis. Yes, there was less liquidity, less transaction, less appetite, but valuation didn't decrease overnight.
Those are some very good points. I would now take a closer look at the two asset classes, starting with the real estate one. I mean, both real estate and tangible assets like watches, wine, and art and other collectibles are physical. They are seen as long-term stores of value, but they work very differently. So I think it's important to also get a better understanding of how they work and like what the differences are in terms of investment. So real estate has traditionally been seen as stable, long-term investment. What makes it so attractive from a diversification perspective?
Well, I think that there's many aspects to it, but let's just speak about three of them. The first one is that real estate is a very tangible asset. The tangibility is one of the aspects that I think is important and why it's important to have real estate in a diversified portfolio. The second one, which is according to me the most important, is the recurring income, is the fact that real estate generates predictable cash flow, and not many asset classes can provide such cash flow. And this is why it's so often very favored by investors looking to generate an additional income. And it's pushed by a long-term demand. Again, why investors like it? Because it generates this cash flow. It's predictable. It's understandable, and it doesn't solely depend on the future price that you might get if you sell your real estate. You still get income on a regular basis, and that's very important. And again, if I go back to the Swiss example, there's strong demand, there's limited supply, and there's low vacancy rate. So all these parameters have a very strong influence on the healthiness of the markets. So if I need to sum it up, I would say that the most important part is the significant return that's generated by the steady cash flow and recurring income. And this is why I think it has its place in a balanced portfolio, because it combines this appreciation of value over time, over long term. And I'll speak about why we believe it's important to be in real estate for a long-term investment, not for money that you will need in the next month, and generate the steady and predictable income on a regular basis.
Very, very interesting. I mean, you mentioned some numbers, so I would like to also give you a number to everyone watching. The home ownership in Switzerland remains below 40. So it is obviously very difficult financially. How does that shape the appetite for real estate as an investment?
Well, I must say that, I mean, Swiss people love real estate, but the issue is that we have the lowest percentage of homeowners of all Europe. Again, I mean, it's 40% of homeowners in Switzerland. If I take the case of Geneva, where we're located, I mean, it's much less than that. And it's due to many entry barriers. I mean, it's complicated to apprehend that asset class. Why? Because you would require a substantial amount of equity, a high income, and obviously a financial capacity to be able to borrow money from a bank. Just to give you a very simple example, if I were to buy a studio, a one-bedroom apartment in Geneva, and I would want to borrow 1 million from a bank to buy an apartment that's 1.3 million on the market, putting 300K of equity on the table, I would need to earn roughly 180K in my household. So just keeping that in mind shows you how difficult it is today to have access to this asset class. And yes, I mean, there's a paradox, because people like the asset class, they understand it because it's tangible, it's comprehensive, but they don't have access to it. So, I mean, our mission since the very first day is to democratize real estate investment. So we were not able to democratize home ownership, but we are able today to democratize access to real estate investment through small entry tickets, a comprehensive and transparent investment experience, and through a platform that in the end proposed, selected, and curated real estate opportunities with a clear understanding and clear explanation on risk and on investment horizon.
Maybe if I can quickly add something here, David, is I mean, thanks a lot for the explanation. As a user of Foxstone, I can also say that I belong to those 40%. I'm lucky to be an owner of an apartment, but for me this is not an investment, right? That's where I'm living in. So basically, it's not the same owning your own apartment versus investing in real estate. There you're looking for rental income, like as you mentioned, cash flow, bigger buildings, which require even more capital. So from my perspective, it's even more attractive, even for owners, right, to have this access to the class as an investment, not just for own usage.
Thank you.
Aurelio, I would really like to thank you for making this very smooth to the next question now. Because, I mean, as you both mentioned, the recurring income is really important. And I mean, one big difference between real estate and other alternative assets is that there is a potential for another income, basically. How important is that for investors that are looking for stability?
Well, I think it's crucial. I think that many investors are looking for recurring income. They're looking for other sources of income, and the fact that we can provide predictable and clear cash flow on a recurring basis is obviously very important for investors. If you couple that to potential capital appreciation and future appreciation, that obviously makes the investment quite interesting. It also corresponds to the Swiss investor mindset. I mean, if you think about Swiss people, they're very much into wealth preservation. A lot of investors that we talk to are looking for long-term investment, and that's very important. Now, one thing that we have to keep in mind is that we recommend investors to be invested for at least a cycle of 5 to 7 years when it is regarding co-ownership, so buying fractional ownership of rental income producing assets. Why? Because in real estate, there are cycles. You need to have the time to be able to work on the potential value, to invest the appropriate capex, to renovate installations, and to make sure that slowly but surely you can increase value of these assets. So a lot of investors often worry about, short-term market movements, but in the end, when you're invested in real estate, you're mostly looking for the long run, and I think that's the very important part of it. So, and as I said, recurring income, because in the end, you get paid while you're owning the real estate as well.
Thank you very much. I would like to move over to the tangible assets perspective, which is now, I would say, Aurelio's topic. So watches, wine, art, and other collectibles like Pokemon card, as you mentioned earlier, have like a strong cultural presence in Switzerland. From just an investment perspective, what makes these assets so interesting?
That's a very good starting question. So I would say that the main reason why those assets are very interesting is because of their upside. As we all know, that we invest money to get more money back, right? So that's very simple. And one characteristics of collectibles and art is basically that they can deliver very strong results. And very similar to real estate, even in times where the whole economy is struggling. I think one very good example here was the COVID crisis. Most of us still remember that very well, right? We had problems with logistics, with supply of raw materials and everything. We were all forced to stay at home. So the whole tourist industry broke. The restoration industry had struggles. Even the producing industries had severe issues. Collectibles and art spiked massively. So as we can see, these assets are not correlated to the general economy, and they can really deliver an attractive upside, even above average. I think that's what makes them so interesting. Obviously, they have to mention that comes with a risk, right? So there is no free lunch. So the surplus in return you can achieve comes with illiquidity, and comes with, I would say, an above average valuation risk. So if you're investing in real estate, if you're investing in stocks or ETFs, you have a quite high confidence in your valuation because of a lot of transactions, comparables, and markets which are effective. In these asset classes, usually the valuations are more linked to assumptions and sentiments, which makes it riskier. So that's then the downside.
You have already, in my opinion, started to answer a bit the next question, which is a lot of value in collectibles comes from scarcity, brand culture relevance, and global demand. How do you evaluate whether an asset has real long-term investment potential?
That's indeed in practice. Like in theory, it's simple. In practice, that's more difficult. At the end, we don't have a solution which is the best in the world. We have at Splint Invest over the last couple of years, we have developed own valuation methods and selection criteria. But I'm pretty sure that there are others out there in the market as well. So for us, the most important thing is data. Data in terms of valuation and data in terms of liquidity. because they are both critical in order to have a successful investment. The most critical point is obviously predictability and track record history. So I'll give you a very brief example. Maybe you have seen the news 3-4 months ago about the Labubu dolls. Like everyone was getting crazy for those little dolls, trying to buy one, prices spiked. Another example, recently launched collaboration between Audemars Piguet and Swatch with the small batches. So we are not following those trends. Why? Because they are spikes based on a short-term hype. They come and they go, and you can hunt and you can trade, but it's not a real investment. So we care a lot about track record and history and data to really evaluate, can we enter the investment at a good price? Because buying at a competitive price is the most important thing when it comes to a successful investment in those categories. And the second thing we evaluate is there liquidity to resell? Because even if you can buy at a very attractive price, if for the next 20 years no one is buying, that's not an investment case. So we have to make sure that there is reliable data on liquidity. There are markets which allow you to resell later. And these are the two main elements from our perspective, which are signals for real long-term investment potential.
Very interesting and good points. To the last question, traditionally high-quality collectibles were only accessible to people with like either specific expertise or, to simply put it, a lot of money. What changes when investors can participate with a lot smaller amounts?
I think what is going to happen on the really long run, I don't know. But what I can say over the next 15 to 30 years, probably what is going to happen is more equality in possibilities to build a portfolio and more competitive markets. I believe personally that if you allow more people to participate in an investment category, this will drive arbitrage down. So it will become more competitive, and probably the upside is going to go down little by little by little, because more and more and more and more people can participate. This positive effect is if more and more and more and more people participate, the liquidity is increasing, which makes the asset class itself again more attractive. Because right now you have very high upside, but high liquidity. And my perception or my idea of the future is by having more people joining that asset class, the upside is going to come down a little bit to benefit more and more liquidity. But again, I don't have what's called like the glass ball to predict the future.
You're not a future teller yet. I would like to thank you for giving us a bit of a deep dive into your asset classes, and would like to now talk a bit more about capital preservation, liquidity, and risk. These themes you have all mentioned before. And when it comes to Swiss investors, they often think in terms of capital preservation first and return second, as I mentioned in the very beginning. How does your asset class speak to that mindset?
I'm happy to start here, David. Please feel free to add on something from a real estate perspective. I think in terms of our asset classes like art, wine, watches, Pokemon, and other tangible assets, it speaks definitely to that mindset of preserving capital. But the main reason why people diversify in those asset classes is actually to get that surplus ROI. So the downside protection is definitely here because we have a tangible asset. So it's not how to say, something which is going to completely be worthless in the future. It cannot go bankrupt like a company. It has a fundamental value, but the main reason why people often go in our asset classes is to really get that surplus in ROI.
Well, the philosophy at Foxstone is that, return is the reward, but risk management is the job. So we look at the deal from a very pessimistic approach, whether it is buying a building in a secondary location or financing a real estate development project. So we would say that we will always do an in-house analysis, and then back our analysis by independent experts, whether it's on the legal parts, on the technical parts, or on just having a financial assessment to be comfortable about the price that we pay and looking at comparables. So we look at deals in many different angles with many different lenses. Obviously, when we're looking at an asset, we will look at the location, at the state of the installations, how much capex we have to invest to maintain or enhance tenant attractivity. When we're looking at the development projects, we would look at the track record of the borrower, making sure he has the appropriate experience. We would look at the structure that will borrow the money, the construction risk, the commercialization risk. I mean, all kinds of risks that we must assess to be comfortable about the wealth preservation and the downside protection. And when we lend money on a specific project, we obviously adds a security package to make sure that, you know, it's collateralized loan. And that's a very important part of it. Just to give you a number, I mean, we propose roughly 5% of the opportunities that we receive on our platform. So we must have a very conservative and robust due diligence process in order to feel comfortable about the investments that we propose. Yeah, I mean, our reputation is everything, especially when you address these investments to sometimes sophisticated, sometimes less educated investors. You have to make sure you did the analysis in the right way.
Both very good and important answers. I would like to move over to liquidity now. I mean, that is something that a lot of the investors take very seriously. Overall, people don't like to feel locked in. How do you explain the liquidity trade-off in your asset class?
I mean, I would laugh about it because it might be the elephant in the room, but I like to address it directly because I think that's key. Real estate is the largest asset class in the world. It's also one of the most illiquid class in the world. Okay, direct real estate is not a daily or weekly liquidity assets. That's important, but I think that illiquidity comes with a price, and it also comes with a premium. The price is obviously not being able to sell it very fast, but the premium also comes sometimes with a higher yield. Now, many investors are okay to lose some points of volatility, but to be able to increase slightly their security on the valuation of the underlying asset, as I said earlier. So again, real estate investors must look for long-term investment. You're not investing money that you will need in the next month. Illiquidity needs to be part of your rationale when you're investing. It's not a surprise. You know that you're investing for some time, and illiquidity is part of your investment decision. Now, again, asset priced on listed markets provide liquidity, and that's the main advantage. But this liquidity is often coupled with volatility. And volatility, I know many investors that don't sleep well at night with high volatility. So, as I said, real estate is driven by other parameters. It's occupancy, demands, evolution of supply. So you have to be patient. Real estate is patient capital, and I think that liquidity has value, but so does patience, actually.
I couldn't agree more. Is there anything you would like to add, Aurelio? I was going to ask you.
Yeah, I would even say, David, that being able to invest in illiquid assets is a privilege. It's kind of like a luxury. It's not something for everyone. And with platforms like Foxstone or Splint Invest, we give more and more people access to such classes, to illiquid assets, by lowering the minimum investments. But it's still a luxury. And from my perspective, you should not try to avoid illiquid assets, but you should factor them into your portfolio in a smart way. You should not put all your money into illiquid assets. That would be not a good advice. But if you can afford that luxury, it definitely benefits your portfolio if you allocate a little bit of it into illiquid assets in general.
I would like to move over to the risks because, I mean, we have mentioned it before. there is always a risk involved and every asset class has one. What is one of the risk investors often underestimate when they first look at real estate or tangible assets as an investment?
I think I've already started to answer that, so I can quickly go first, David. I think in
Sure.
tangible assets like art, it's all about valuation risk and illiquidity. I think those are the two main topics which we should never forget about or underestimate. I think the illiquidity is more visible. I think that's known. The valuation risk is more hidden, but it's still very, very critical. You can think about paintings from Picasso, right? They're all unique. So how do you really determine the fair value of a unique item? So that's what I would probably mention as the two underestimated risks in our class.
I mean, there's a familiarity about real estate that creates a wrong sense of comfort. And yes, I mean, any investment has risks. Now, I would assess risk in two different ways, depending if we're, purchasing an asset or financing a project. In the end, like Aurelio said very wisely, it's all about what's the valuation when I need to sell it and how fast can I potentially sell it. Now, if I need to point out a couple of risks, I would say that, I mean, interest rate is a risk even in direct real estate, because if we're trying to sell 80 units in a specific location, an interest rate spike, then we might have less demand at the specific time. I mean, renovation risk, depending if you don't work with you work with companies that are not doing the work properly. Vacancy risk, which is very low, but it has been very low for the past now 5 years, but it's been higher 10 years from now. Construction risk. I mean, I see all kinds of risk, but what's important about risk is how you mitigate them. And I think that comes with the proper assessments. And you said something before, Aurelio, that struck me, and I always agree. It's all about, the entering price. What's your price you're entering the market? Because obviously, if you're entering at a decent price, then you feel more comfortable. I think that's to come back on a building. A great building can be a very poor investment. If it's overpaid, if it's over leveraged or poorly managed, it's still a bad investment. Now, our approach is always, as I said, to be cautious and to make sure that we analyze it from different angles. So we will be looking at many different things: macro, micro location, capex, state of installations, cash flow assumptions, downside scenarios. I mean, we will be looking at an asset like an institutional player will be looking at, will be doing his own due diligence. And we cater this level of sophistication in our due diligence that we provide to, regular people, people from the middle class that are looking to deploy capital in this asset class, but with informed decisions and with access to as much transparency about risk and a proper understanding of the investment horizon.
Wonderful, thank you. For the last section, we can imagine it more as a bit of a summary of this whole webinar. We cannot go very much into detail as we did before, so I would like to ask you both to just briefly sum up all the 3 questions that are following, so we have enough time for the Q&A session at the end. How can real estate and tangible assets complement each other? Where are they similar and where do they behave differently?
So that's a good question. I will start here. I think that in terms of diversification, or in terms of adding diversification to a portfolio, both asset classes are very similar. I would also categorize them both as satellites in a portfolio. I think where they're different is in the additional benefits they deliver. I would say that at least from my personal perspective, one of the huge benefits of real estate is the underlying cash flows. So we're not talking about only betting on value appreciation, but we are investing our money into something which generates cash flows. And even if the real estate market is going down and the property is losing some percentage of values, as an investor, I don't care that much because I do it for the steady income. On the other hand, I believe that tangible assets, they can really deliver this additional alpha, this additional upside in return, which might be less available for real estate because it's so competitive already. So that's how I would place it, but very curious to hear your thoughts, David.
Honestly, you said it all. I have nothing to add here. I think they're very complementary asset classes, and the combination of recurring income in real estate and potential capital appreciation that's provided by other alternative and tangible assets is a good combination. I have nothing else to add here.
Wonderful. Are these asset classes only relevant for experienced investors, or can they also make sense for people that are just starting?
I think it's for both, and this is also why we started this company, is to make it more accessible to the understanding of everyone. So yes, I mean, real estate can be for very sophisticated investors, but in the end, if the information is transparent and you start with a reasonable allocation, I really think that you don't need an expert to properly understand real estate. As I said, it's an easy to understand, tangible and comprehensible asset class. It's linked to the real world, so it's not like you have really you need sophistication to understand it. But what you need to understand, and that's the most important part for me, is what you own, why you own it, and what's the risk you're taking. And that in the end, you can link that to any asset class. And I think that it's important as a platform to properly inform our investors about these aspects to make sure they take informed decisions and they have all the information at hand with regards to taking the first step and the first leap of faith into making an investment with us or with Splint Invest.
I would like to move over to Aurelio for this question. What is one mistake that you often see investors make when they first step into alternative investments?
Oh, that's a good one. So what we can see on our platform is basically, and maybe I need to quickly explain, on our platform, you can invest in individual objects. So you are not like investing in a portfolio, but you can really choose on your own asset by asset. So you scroll the app, you check this art piece, that watch, this wine, and you can decide to invest individually. And the minimum investment per item is 50 Swiss francs. So this is a very low threshold, right? Something we observe from time to time is that people create an account and they would like to invest, let's say, 1,000 Swiss francs. And instead of spreading those 1,000 Swiss francs into many individual items, they put everything in one basket. So their intention to diversify with tangible asset is good, but then the implementation operationally doesn't work. So basically, I would always recommend if you have a certain amount you would like to invest, use the benefit of this 50 Swiss francs per item and continue the logic of diversification even inside the category.
That is a very, I mean, it's also said to put your eggs in different baskets and not all in the same one. I would like to move over to the Q&A session, which I believe will be led by you, Aurelio, since you have all the questions.
Yes, and as I can see, we have quite a lot of questions here in my backlog. So I will quickly screen through it and select a few of them. I think in case we cannot answer all of them, we probably can reply then in a summary email at the end of the session.
Sure, it's a good idea.
So the first one I would like to pick up here is my money is safe in the bank and my pension is taken care of. Why do I need to do anything else on top? That's a very good question. David, do you want to pick that up?
Sure, I'll pick it up. I mean, your money is obviously safe in the bank, and it's good that it's in the bank and it's a security. But again, in an environment of low interest rates and potential inflation, your money is losing its value over time. Your pension fund is already potentially being invested in real estate as well, because a lot of the pension fund is invested in direct real estate. But it's generating a yield that might be below what you could look at if you invest in real estate with other platforms or through different means. So I think it's done one or the other. It's complementary allocations within a balanced portfolio, and it will really depend on what are your investment criteria, what kind of risk you are willing to take, what kind of investment horizon you will be looking into. But I think that it's not one or the other. It's real complementary exposition to different asset classes.
Great. Thanks, David. I hope that was answering the question. then let me check. Oh, that's a very similar one. So let's pick that up as well. How should investors think about time horizon when investing in real estate or tangible assets? So I think, David, you already mentioned the cycles, right? The real estate cycles of 5 to 7 years. So let me quickly pick that up and answer it from a tangible asset perspective. I think there, you should always approach it from a perspective of I invest now money, which I don't use in my day-to-day life for the next I would even say 10 years. Why? Because then you're on the safe side. Our assets we source for our community and on our platform usually have an investment period of 3 to 5 years, which I would say is midterm, not long term. But I would always go for the worst case. Why? Because there is nothing worse than emergency sales. So that's really from an investor perspective, that's the worst thing you have to do, being forced to exit an investment. So let's try to avoid that, and let's always build in this buffer of a few more years.
I'll just add something there because I spoke about, thank you, Aurelio, and that was super, very clear. I spoke about the cycle of 5 to 7 years. This is with regards to income producing assets. We also propose financing opportunities. So the opportunity for investors to finance real estate projects. These are short term. They usually are linked to projects that are 12 to 36 months. So we also have a possibility of investing on a shorter term.
Cool. Thanks a lot, David. Now I see that we have a few going into a similar direction. So let me summarize it. So basically the questions are going into what is an ideal diversification rate? How much should I allocate in real estate? How much should I allocate in alternative tangible assets? What is a rule of thumb? We have quite a few of them. So I think we should tackle them. Do you want to start, David?
I can start, but I'm not going to give a specific percentage because I think this is very personal and very much linked to one's, personal investment criteria and approach to risk. But I think that a balanced portfolio would have obviously a couple of ETFs that are diversified rather than picking stocks. It's very difficult to pick stocks. I think it's better to be able to invest in an ETF that's spread across different investments. I'm still very keen on owning some metals, but that's on a very personal level. Real estate, as I said, to generate recurring income, and then, as you said earlier, collectibles, tangible assets to go and grasp for some alpha.
I agree. I also think we should not give any concrete numbers as recommendations, especially because that's why you also have like some financial advisors doing their job, right? But there are good theories out there. I think the core satellite theory is quite helpful. I always try to reference to that. I also build my portfolio based on that I say, look, I would like to build a core, and for me the core is highly liquid stocks through ETFs, not single stock picking. And then I built my small satellites, which are in my case precious metal, art and tangible assets, a little bit of real estate, but also peer-to-peer loans. And I usually try to keep them in a single-digit percentage of the total portfolio, but that's just my personal strategy. Great. Then, this is a very good one. And I think it's mentioned a second time here as well. Yes. What is not the guarantee, but what evidence do I get as an investor that the real estate and the tangible assets which are offered on your platforms really exist and are in your ownership? I think for you it's easy, right, David? You can go and check if the building is there.
Yeah, well, in direct ownership, it's very simple because, as you said, the building actually exists. It has tenants. It has real people inside. And not only that, but you get a share of ownership, which is in your name in the land register. So you actually own a percentage of the building in your own name. So it's very easy. In the case of financing a real estate development project, most of the development projects are already in construction, the units are being sold on the market. So again, it's visible, tangible. But in this case, you don't own a part of the asset, but you're just financing the development project.
Great, thanks, David. And in terms of Splint Invest and our tangible assets, it's very similar. You acquire the co-ownership. The only difference is that there is no central register which keeps track of the ownership like in real estate, but we maintain that ledger. What you receive as a confirmation is independent storage confirmation from a third party. So the confirmation that a storage center actually received that good physically. You receive all the contracts where ownership is transferred to us first in an initial step, and then to you in a second step, which can be validated in extreme cases even by a visit of the storage facilities where you can go and validate by yourself. On top, but this is more a governance topic, we are audited every year in terms of existence of those assets. So there is an independent auditor checking all facilities with a list saying Ferrari 1, 2, 3, is it there? Check. If not, we have a problem. So basically very simple.
I think we have time for one more question, if there is one more, of course.
There are quite a few. Let me see if we have ones with multiple mentions. I think this one could be an interesting. It's more relevant for you, David, but I think it's a good one. It just came in 2 minutes ago, and it's asking that on the Foxstone website, all projects seem to be fully funded and closed. Do you know when more projects will come?
That's a very good question. Well, we will have more projects on the platform during the month of July. We're still working on finalizing the structuring of a couple projects. So yes, we will have more projects during the month of July. And hopefully during the next couple months, we'll have a recurring deal flow on the platform.
Wonderful, thank you. Then I will take over again. I would like to thank you both for sharing your perspectives and your knowledge with all of us. And I would like to thank everyone that joined us today as well, of course. I think a key message is that diversification is not only about owning more products, it's also like understanding what you own and how those different assets behave and how they can complement and work together in different market environments. As a thank you for watching today, both Foxstone and Splint Invest have shared some QR codes with you that you can just scan with your phone. We can also share the presentation later on if you want. For Splint Invest, you will get a starting bonus for their app. For Foxstone, you will be the first ones to get a new offer, which was apparently just wanted. So just scan the QR code and then either enjoy both of the benefits, actually. You don't have to choose today. So in case you have any last words, David or Aurelio?
Just wanted to thank you. It was a real pleasure to be here, pleasure to share this time with you, Verena and Aurelio. And yes, thank you very much.
Same here. Thanks a lot for joining, and wish you all a lovely and hot week.
Bye-bye.
Thank you. Bye.